Hi, I'm Pattu from FreeFinCal. Today let's talk about invisible mutual fund risks. Now, when we talk about mutual fund risk, the only risk that many people assume is present is the NAV of the fund moving up and down. That is the day-to-day volatility, but that's just one component of the risk. In fact, when the mutual fund Sahi Hai ads are going through their second innings, as I mentioned here, they mention a line that mutual funds are suitable for those who wish to understand risks before investing. what? So the AMFI is aware that the young earners who came into the market in the last few years, from 2017 or so onwards, they have realized that mutual funds are not going to always give you returns, and risk is a part of the game, and that's why they've been a little more cautious in designing their second campaign. Although nobody from the mutual fund industry really wants investors to understand risks, because in November 2019, I found that 78% of netizens said that if first time mutual fund investors understood the actual risk present, they will never buy mutual funds. So the industry doesn't want you to understand risk. That's just some some words to for the sake of it. So let's talk about invisible risk. And by invisible risk, I'm not talking about risk that's actually invisible. It's there, but we just don't want to pay attention to it in our search for a convenient truth where we believe if we just keep investing, everything nice will happen to us. That's not going to be the case. So the first kind of risk I want to talk about is the just give me returns risk. That is, people don't read scheme documents, that they will not do any kind of analysis. They will simply go on Google and start what are the best mutual funds to invest in 2021 and so on. So if you are going to ask such lazy questions, then you're going to get what you deserve. The second big problem is not from the part of the investors, but what I would like to call as enticement risk. If you read the scheme presentation documents or the scheme brochure and not the actual scheme document, the scheme information document, you will realize that what actually mutual funds are doing is they put in all kind of strategies, and they'll say we are going to use this kind of special technique, unique method, unique neural networks, artificial intelligence, this and that to pick stocks and so on. But none of those statements are actually present in the scheme document, and SEBI is not doing anything about it. I don't know why. So this is a big risk that's present. So please be careful and read only the scheme information document, because all these brochures are basically meant just to get sales. Now, the next one is credit risk. You may say, okay, what's the big deal? Everybody knows that bonds defaulted. No. To this day, I find that people believe that if they invest in a mutual fund that has only AAA bonds, there is no credit risk. That's wrong. And they believe that banking and PSU funds are safe. That's not true at all. You can find many popular bank bonds which are AA rated and so on. So, and any AAA rated can fall down to any lower rating suddenly, just like that. So there is credit risk can never go away in debt funds or any kind of hybrid funds holding bonds. So that's very important to appreciate. Then there is this mass redemption risk. Now, what happened to the Franklin funds is a case of mass redemption risk. That is, when everybody wants to pull out, then the fund manager is in serious trouble. But the mass redemption risk is not the same as credit risk. What happened in the case of Franklin was investors fearing the nature of the portfolio and collectively losing faith in the portfolio, and they wanted to pull out. It's basically a mini stock market crash within the Franklin unit holder universe that happened. They collectively lost faith in that portfolio, although there was not any actual default at that point in time. So that is different from actual credit risk, and such kind of collective lack of faith can happen even in a small cap mutual fund. So it's not just for debt mutual fund, and it is important to segregate mass redemption risk from credit risk. They are two different issues. Then there is what I would like to call as safety risk. That is, every time an investor wants a safe option, you can always see that they are ignoring some kind of risk. There is no such thing as a safe option. And I have seen people say gilt mutual funds are safe because they are from the government. That's just nonsense, because gilt mutual funds are marked to the market, and government bonds, longer the duration of the government bonds, the wilder will be the fluctuation. I have been talking about getting pension from 30-year-old, 40-year-old bonds. If a mutual fund buys that 30-year-old, 40-year-old bond, your portfolio volatility will be almost equal to that of a equity fund. That's how volatile that portfolio will be. So please be careful. Don't search for safe options. That's always going to be dangerous, whether it is in mutual funds or anywhere else. Then there's something called reinvestment risk. That is, people say that no, I don't want any kind of interest rate risk. I don't want any kind of credit risk. I want a safe mutual fund, like a liquid fund or a money market fund, where the NAV will just keep on increasing. What people do not understand is the NAV may keep moving up. Excuse me. The NAV may keep moving up, but the rate at which it keeps moving up will change. Sometimes it will move up fast, sometimes it will move up slow. That's called reinvestment risk. That is, what will happen is, at one point in time, a liquid fund may hold high coupon bonds. When the interest rates go down, then when the bonds mature and the fund manager buys new bonds, then the coupon from that new bonds will be lower. And over a period of 20 years or so, when the interest rates go down gradually, then liquid funds will produce lower and lower returns gradually. That's called reinvestment risk. That is, they are reinvesting in bonds of lower interest. Then there is concentration risk. We have seen how concentrated the Nifty is, the Nasdaq is, and so on. For example, Google is going to face serious antitrust lawsuit. If they are in trouble, then Nasdaq will fall, and they can bring all others down with them. The entire sector can come down like a domino effect because of that. And certain companies may profit because of a certain government in power. And if the power shifts, then that company can get into trouble. And if that company actually forms a big part of the index, then the index will fall. So those are risks that can happen, not just to index investors, but to everybody. Now, then we have expense ratio risk. We have seen many times mutual funds, when they want more of AUM, they will drastically lower the expense ratio. When the AUM comes up a little bit, they will jack it up. And at certain times in the financial year, we have seen sudden changes in the expense ratio, and SEBI is not doing anything about it. Then you have riskometer risk. We now have a riskometer gauge for mutual funds, which can change every month like an expense ratio. I basically don't understand how mutual fund classification in terms of risk can vary every month. It's just bizarre. So basically, much of this is because of the regulator. The regulator themselves are causing problems to investors, because you can't. SEBI has a weird mandate of wanting to increase mutual fund awareness. How can you increase mutual fund awareness without affecting investors? It's just not possible at all. Then there is resource risk. For example, people like me, following people like me, or bloggers, or website media, and so on. They are also living and learning. Their opinions may change. They could be wrong. So unless investors do their own research without depending too much on idiots like me, then they are going to be in trouble. So that also is a very important invisible risk that many investors do not appreciate. So that's all I wanted to say in this. I'll catch you later. Bye bye.